Okay. Find a seat, get settled in. Going to start in about 20 seconds, so find a seat, get settled in. Okay, all quizzes are in? Okay. This. So, what was the answer to the first problem? I heard 9.37%. Is that the answer? 9.37? Or is it 9.06? Some of you might have already guessed that there were two versions of the quiz floating around. And because I alternated the quizzes, if you turn to the person next to you and check your answers, they'll all be wrong. Okay? So, you're saying, why didn't you tell us? I remember I've always done this, and about 7 or 8 years ago, want to sit down?
Yeah, I was going to ask you, when are you going to start?
Any moment now. About 7 or 8 years ago, somebody came up to me and said, that's very deceptive of you. I said, deceptive in what sense? He said, you never told me that my neighbor's quiz was different from mine. I said, you know you're digging a hole for yourself from which you can't dig yourself out of, right? You have a quiz in front of you, just do it, right? Who do you care what your neighbor's quiz is? Right? So I think that was about as straightforward a quiz as I've written in a long time. Right? And I blame Bill de Blasio for this. You know why I blame Bill de Blasio? Why do you think school closed on Monday? Because NYU's school closing now is linked up to the public school, New York public schools. You know why the New York public schools closed, right? Because Bill de Blasio screwed up on the last snowstorm. So guess what the city decided to do for this snowstorm? They decided to be preemptive about it. They canceled classes. They got all the snow equipment. On Monday, do you see all the snow equipment on the streets to remove no snow on the ground? I don't know how much it cost the city, but it really pissed me off. I mean, I was actually on the way to the airport on Sunday when I found out. And it reminded me of one of the favorite posts I've ever written. It was about 10 or 15 years ago. My kids are all still in school, ranging from lower school from the second grade all the way to ninth grade. And we wake up in the morning and it's snowing. Immense amounts of snow. I don't know how many of you grew up on the East Coast or in cold areas, but when you look out of the window and you see lots of snow as a kid, what's the first thought that comes to mind to you? Snow day, right? And that's what all four of my kids, snow day, they're dancing around. And I look out of the window and I say, oh shit. Because you know, I live in the suburbs, I see snow, you know what comes next, right? The snow is not going to remove itself from my driveway. I've got to get the damn shovel and I've got to get out there. So I wrote a post called Snowmen and Shovels. It's about value and growth investing. See, what's that got to do with value and growth investing? When value investors look at a company, they look at the company like I did. They think about all the bad stuff. I've got to shovel the snow. Growth investors look at the same company like my kids looking out of the window. You need both to keep the world going, right? Because if everybody were snowmen, shovel type of people, you're going to get depressed and kill yourself. If everybody was snowman type of people, nobody's going to get their driveways shoveled out. So hold on to that thought. When you think about what's different between value and growth investing, think snowmen and shovels. It's pretty much going to capture it. But I did put that, I did this for you on Monday. $275, I expect a check in the mail any moment. Right? Because that's what it cost you, that one canceled class. I don't know how many classes you lost, but if you lost 4 classes, that's 4 times $275. That's a lot of money. So I decided to do my small part to make your loss lower. So let me ask you a question. How many of you actually watched the video I made on Monday. Okay, that's what I expected. Why? Because you have a quiz today, right? I want you to watch that. It's an hour long, basically talk. But let me very quickly summarize what I said in that video, because since we're going to build on it, I can't leave it kind of unattended. I completed the discussion of growth by bringing in two other scenarios. Because if you remember on Wednesday when we talked about growth, I made a big deal about this fundamental growth. How much are you reinvesting? How well are you reinvesting? We danced. It made growth look like such a neat mathematical equation, right? Reinvestment rates or return on capital. I've got the growth rate. On Monday I said, wait, that's going to work only if your company has a return on capital, return equity that is stable. If your company's returns are changing, then your growth rate is actually going to be much higher than the growth rate you get from the fundamental, or much lower, because depending on the change, you're going to get at least a short-term effect on your growth. And then I went to the most general scenario. I put up my Lyft valuation. I'm sure that most of you haven't even looked at it yet, but one of the problems with Lyft is I can't do return on capital times reinvestment rate. Why? What's the return on capital for Lyft? It's a big negative number. What's the reinvestment rate for Lyft? It's a big negative number. Now you think this is very convenient. Big negative number times big negative number is big positive number. But you put that growth rate on your operating loss, what happens to a loss which you let grow? It gets bigger. So with a company like Lyft, and this is the most general scenario, I said you got to dig yourself out of the hole. By doing what? You start with revenues, because that's the number they're so focused on, and you build up to revenues over time. Will that require making assumptions? Yes. In the case of Lyft, I had to tell a story. Is Lyft going to be a US transportation services company? Or like Uber, is it going to be a global logistics company? In fact, Uber versus Lyft tells you the importance of stories, right? The Uber story is much bigger. It's all things to all people. They're Uber delivery, Uber moving. They're going to be in Denmark. They're going to be in Indonesia. They're going to be all over the world. But Lyft is a much more focused story. There are pluses and minuses to both, right? When you tell a big story, you're more likely to get a big pricing. But when you tell a big story, it's also going to be much more difficult to deliver on that story. As Uber has discovered, it's much more expensive. You're distracted. And Lyft, I think, has the right side. They've stayed focused, and their prospectus shows that focus. Not in terms of bulk. It's like 225 pages. Do you read this? Take a look at the prospectus. It's 225 pages. I don't know whether any of you valued Apple and Amazon, but when I put up the 10K for Apple, you know how long Apple's 10K was? 87 pages. That tells you there's no correlation between how long a prospectus is and how... In fact, there might be a negative correlation. The less you have to tell about yourself that's good, the more you bullshit. But if you cut through the bullshit, it's basically about building up revenue growth, projecting what you think they will generate as margins, which requires a different story. And then coming up with expected operating income that over time will go from negative to positive. And to tie up loose ends, I still need to estimate reinvestment rate, but I can't estimate using return on capital or reinvestment rate. So here's what I do. I look at the only number that is positive here, revenues, and I tie my reinvestment to how much your revenues are growing, which actually is both pragmatic and that's the way the company thinks. So if you want to double your revenues, you will have to reinvest more than if you want to grow them just 50%. So 3 layers, revenue growth, margins, reinvestment. I come up with free cash flow to the firm. Take a look at those free cash flows. They're negative for the first 6 years for Lyft. In my optimistic story, they're negative precisely because my story is optimistic. Why? Because I'm giving them high growth, and because I give them high growth, they have to reinvest a lot. They're going to burn through cash for the next 6 years. And then the cash flows turn positive, and I come up with a value of about $16, $17 billion for Lyft, which is not bad for a company that lost $1 billion last year and has $2 billion in revenues. So I have no qualms about attaching a high value to a company, even if there's nothing there. But that's the most generic way of valuing a company. You can use this for young growth companies, distressed companies, mature companies. For any company, you can take the revenue, margin, reinvestment links and basically build up to a valuation, which is what one of my valuation spreadsheets, the FCFF Simple Ginzu Spreadsheet, does it. For those of you who have no idea what a Ginzu is, I came to the US in 1979. I'd never watched TV in my life. You're saying, what part of the world? With the primitive parts, that you grew up in. I grew up in part of India, Chennai, which actually got TV after everybody else. Because everybody's too cheap in Chennai. They say, why would I want a box which shows only 30 minutes of things I don't want to watch? The first show, I turn on the TV. I moved to LA. Can you imagine the culture shock of moving from a place with no TV to a place where it's all TV. Everybody lives on the TV, I think. And I turned the TV on. The first show I watched was an infomercial. You know what an infomercial is? It's 30 minutes where somebody's trying to sell you something. And this guy was selling Ginzu knives. It's legendary. It's one of the first infomercials ever made. And in the commercial, here's how it starts. You want 3 Ginzu knives, it'll cost you $99. Oh, wait, if you send in your $19.99, we'll throw out 3 more. And by the time they were done in 30 minutes, you had enough Ginzu knives to slaughter an entire population. It's like 500 Ginzu knives for all kinds of things you never do. I call the spreadsheet the Ginzu Spreadsheet because it started small. Then I said, you know what? Wouldn't it be nice if I could build in the lease capitalization into the spreadsheets? I put it in there. I said, wouldn't it be nice if I could put the R&D I put it in there. So like a Ginzu knife, you look across, there'll be worksheets from now through eternity essentially trying to do that. But the simple Ginzu spreadsheet is built around these 3 numbers. That's the most generic way of estimating growth. And then I talked about terminal value, and I want you to go and watch the session just for that. Because if you talk to people who do valuation, when they talk about terminal value, it's with awe and fear. Awe because it's such a big part of your valuation that you're afraid you've screwed up. So everything becomes forced now. They don't even pay attention to the next 10 years. They're so focused on the terminal value. So I suggested 4 simple rules that you can follow to keep the terminal value from running away from you. Because it can very quickly take over your valuation. The first rule I said is cap the growth rate. Cap the growth rate at what? Because first I said don't apply a multiple to EBITDA or EBIT and call it terminal value because it's not an intrinsic valuation. But if you use a perpetual growth model, make sure the growth rate you use is a growth rate you can sustain forever. And if that is the definition of a sustainable growth rate, it has to be less than or equal to what? The growth rate of the economy. Less than equal to R is a very minimal requirement because that's a math requirement, right? Your growth rate has to be capped at well below R. It's got to be capped at the growth rate of the economy in which you operate. Why? Because if you grow as a company faster than the economy, and you do it forever, at some point in time you become the economy. Then what? So I said cap it at the growth rate of the economy. And then I suggested a proxy. Let's see how many of you actually watched, or any of you watched what that proxy, did any of you see what proxy I suggested for the cap on your growth rate? I said use the same risk-free rate used in your valuation. You're going to say the risk-free rate. So let's act like you said it, so the risk-free rate. And my explanation was very simple. I said the risk-free rate carries information about future growth and future inflation. You can't just walk away from that risk-free rate. So if you're doing a valuation in Swiss franc, guess what? The negative risk-free rate helped you on the discount rate. Now I'm going to come back for the other half of the bargain. So cap it at the risk-free rate. So that's the first rule. Second, don't wait too long to make your company a mature company. Because if I look at a company like Lyft, lots of promise, lots of potential, what's your first instinct? I should give them at least 25 years of growth, 30 years of growth, 50 years of growth. As if that's easy to do. You know what the median growth period for a growth company in the US is? How long growth lasts at a typical growth company? Guess. It's 3 to 5 years. It's scary how quickly growth fades at most companies. I can already see someone say, but Microsoft grew for much longer. Walmart did. The very fact that we can name the companies that have grown for much longer than 10 years tells you what? That they're the exception rather than the rule. That's like looking at every quarterback and saying, hey, there's the next Tom Brady. He throws just like Brady. You cannot make the exception the rule. So I'm not saying you bring your growth period to 3 or 5 years. For my Lyft valuation, I use 10. I have never, ever used more than 10 years in a discounted cash flow valuation. Here's why. If you can grow more than 10 years, I think of it as icing on the cake. I deserve the icing. I'm not going to pay for it up front and then be disappointed because you grow only 12 years rather than 25 years. Don't wait too long. Third, just because you're a mature company and you're growing at a constant rate forever doesn't mean you can stop reinvesting. The reason I say that, it's an amazing number of intrinsic valuations or discounted cash flow valuations. We'll get to year 10, the analyst will say, my company is now a mature company. I'm going to assume CapEx offsets depreciation. Tell me mathematically, what have I just done? My net CapEx is then 0. The change in working capital is non-existent because working capital, so change in working capital is 0. Humor me. What's 0 plus 0? 0. What's 0 divided by 0? 0. What's 0 multiplied by any number? 0. One of the great things about 0 is it's a one table you always remember, right? Nobody says, what's 0 times 7? If you're thinking that, then you've got a math issue that I can't deal with. But you see where I'm going? If you reinvest nothing and you have no working capital change, what's the only growth rate that's consistent with a reinvestment rate of 0? 0. So if you want to use a 0 growth rate forever, but here's what analysts do. They assume net capex is 0, change in working capital, oh, by the way, I want to grow 2% a year. Not going to happen. So if you tell me you want to grow at 2% a year, I need to make sure you reinvest enough to sustain that growth rate. You're saying, how the heck am I going to do that? What's the fundamental growth equation? Reinvestment rate times return on equity, return on capital is equal to the growth rate, right? So if I tell you the growth rate is 2%, and I tell you the return on capital in this company is 10%, how much will I need to reinvest to get the 2% growth rate? About 20%, right? That's the missing variable. You tell me how quickly you want to grow and what your return on capital is as a stable company. I'll estimate your growth rate. And I did a table there where I looked at what happens to your terminal value as you change your growth rate. Again, what's a conventional wisdom? If I hold all else constant and change the growth rate, increase the growth rate, what should happen to my terminal value mathematically? It should become larger, right? But in that table, if you look at the middle column, I change the growth rate from 0% to 3%, and my terminal value stays exactly the same. It's like magic. And you know why? Because I assume that this company has a return on capital of also 10%. If my return on capital is equal to the cost of capital, I will grow and I will become a bigger company, but I'm creating no value. Why? Because I'm essentially taking 0 net present value projects. Your big assumption in your terminal value calculation is not your growth rate forever, it's what kind of return on capital you assume in perpetuity. And then I suggested a final rule, which is if you make your company a mature company in terms of growth, give it the other characteristics of a mature company. So let's say I value Lyft. I gave it a 9.97% cost of capital at the 75th percentile. Why? It's a young, risky company that's losing money. By the time I get to year 10, you know how much I give Lyft as revenues? About $22 billion. And they're making $3 billion in operating income. You're saying, so what? It's one thing to give my company a high cost of capital. It's a young company that's losing money. But on my own spreadsheet, what am I doing to the company? I'm making the big, mature, stable company. So what should happen to its cost of capital over time? It should move towards something close to the average. So if you look at my Lyft valuation, it starts at 9.97%. But over time, as my company gets bigger and more mature, it drifts down to the cost of capital of a typical U.S. company, which is closer to 8.24%. Follow those 4 rules. Obey the cap. Don't wait too long. Reinvest enough to sustain your growth rate. And give your company the rest of the characteristics of a mature company. And if you do that, you will stay in control of your terminal value rather than the other way around. And try at all costs to avoid what I call Buzz Lightyear valuations. You know what that is? You sit there and you start playing games with G. G starts at 2, then you go 2.5, 3, and then your cost of capital is 8. As you approach 8, where are you going? Come on, you've seen the movie. To infinity and beyond, that's where you're going. So at all costs, put up a picture of Buzz Lightyear above your desk if need be. Get a walking doll of Buzz Lightyear, says, to infinity and beyond, to remind you not to mess with the growth rate. This is not a game. It's not a math exercise. There's an economic intuition and first principles you got to follow. So that's where I left you off. And if I stop there, what do I have? So far we've talked about discount rates and how to get there. We've talked about growth rates. We've talked about cash flows. And now we've brought in the elephant into the room, the terminal value. You have everything you need to complete the discounted cash flow valuation for your company. Or let me take that back. A discounted cash flow valuation is the operating assets of your company. So here's what I'd like to do. I'd like to complete the story by tying up what I call loose ends. And you're going to find as we go through this, there are a heck of a lot of loose ends in this process. You know what loose ends are? These are all the things you have to do after you tell me you're done. This is where the real damage happens in valuations. So I'll give you a little bit of the history for this particular portion of the class. It didn't used to be that 15 years ago. But about 12 years ago, I had a sabbatical. You know how sabbaticals work in academia? I work incredibly hard. I have to teach like 4.5 hours a week for like 35 weeks. I just get only like 6 months off in the middle. And because I work so hard, every 7th year I get the year off with pay. That's pretty conventional, right? Wherever you go to work, I'm sure that's going to be true. It's called a sabbatical. And usually people have big plans for their sabbatical. They're going to write books, they're going to do research. So about 12 years ago, sabbatical is coming up, and I decide that I was going to do absolutely nothing for a whole year. That was my end game. 365 days with nothing to do. And I make a confession, I was a little ostentatious about it. So the first day of my sabbatical, I go to Staples, I get one of those to-do boards, you know, the ones you write on. I put it right above where I sit at home with nothing on it. And as the kids came down to go to school, they were still at home, I pointed to them and said, look kids, I have nothing to do today. Pissed them off no end, but then they left. And then I made my fatal error. My wife came down the stairs and I said, hon, I have nothing to do today. Famous last words. She said, really? Why don't you walk the dog? I walk the dog, I come back, there's something on my to-do list. I said, what the heck is this? My plans have been shot. It says, pick up bok choy at the grocery store. I had no idea what bok choy even was. I was too embarrassed to ask. Is it the seafood? Turns out to be ugly looking cabbage. It took me about 2 hours to find it. I get it, I come back, there's another item on my to-do list. Pick up kids at school. Magically, and after about the 3rd or 4th item, I said, I have to find things to do to keep my wife off the list. I'm desperate. Give me something to do. And I get an email from the editor of CFA magazine, a magazine I've never read, I didn't even know existed. He says, would you write a 1-page article for us? My first reaction, I'm on sabbatical, I want nothing to do. But then I remembered I needed things to do to keep my wife off my list. So I said, yes, I will write a 1-page article for you. Big letters on my to-do list said, write 1-page article for CFA magazine, cannot pick up bok choy kids, etc., etc., etc. And I did, and I have to tell you that this is the only thing I've ever written in valuation that's got me hate mail. You know how difficult it is to get hate mail in valuation? People don't feel strongly enough. They say, I hate you for using implied equity premium. I hate you for doing bottom-up betas. This actually got me hate mail. Part of it was the title. I said, stop the garnishing. And I was talking about the process, especially in appraisal, of valuing a company and then adding 20% for control and 35% for synergy and knocking off 15. I said, you got to stop this, because if you do this, there's no point to valuation, because you're going to back into whatever number you wanted to see in the first place. And I might have used the word arbitrary to describe these premiums and discounts. It's really pissed people off. And a wave of hate mail starts coming in. I actually had to create a smart mailbox with all the words that I would look for in a hateful email. You idiot, fool, etc., etc. It's actually, you know, on a Mac you can say, if any of these words appear, put it into the hate mail smart mailbox, and then you delete the whole thing. But one of the emails actually did not use any of the hateful words. It crept through my screens and came onto my regular email. It said, if you think what we're doing in appraisal is so bad, why don't you come up with a better way of doing it? I said, you're right. I'm not saying control is not worth money. I just don't see why it's always 20%. I'm not saying liquidity doesn't matter, but why is it always 25%? So I had 11 months left in my sabbatical, and here's what I did. Every month I picked a loose end. First month I picked control, and I said, if I were valuing control from scratch, how would I do it? I spent an entire month. Then the next month was synergy, and the next month was liquidity. It's actually half of one of my books today. The Motor and Valuation, which is, you know, the egoistic most, because when I wrote it, I'd never written a book before, and I remember, can I put O.J. Simpson on value? Because this is the time of the O.J. Simpson trial, maybe more books will sell. Yeah. But this is now the second half of one of my books. So I'm going to take you on a ride through some of those loose ends. I'm going to start off with something I thought we'd already settled, which is, if you have cash on a balance sheet, how should we value it? What was the rule we came up with? Don't mess with cash. If there's $100 of cash, it's worth $100. I'm going to raise a provocative question. Now, there's some companies where you see the company as $100 of your cash, but you might decide to value it at only $80. And if so, why? And there are other companies where you see $100 in cash where you might attach a premium. So let's start with that. Second, I'm going to stop and ask the question about cross holdings. holdings in other companies. In a perfect world, how would you value a company which has lots of cross holdings? And this is more the rule than the exception in Asia and Latin America. How do you value cross holdings? Third stop, I'm going to say, once I've done my DCF valuation, I've dealt with cash and cross holdings, is there anything else I should be adding on because the company owns other stuff? What about if it has valuable real estate in New York? Should I add the value of that real estate on? What if the CEO is buying Picassos using it? What about the Fifth Avenue apartment that the city owns? The helicopters, should I be adding those assets on? And then when we get to debt, I'm going to ask, well, I subtracted out conventional debt and leases as debt. But what if there's a lawsuit on this company? This is your last chance to mop up. What else should I mop up for? Then we get to the value of equity. Usually we divide by the number of shares outstanding. And they say, what if the company has options that it's given management? What if there are two classes of shares, voting and non-voting shares? Things you don't even think about till you get to that stage. And I'd like to take those loose ends and kind of tie them up. So let's start with the first of those loose ends. As I said, in conventional valuation, any book including mine, what do you have to do? Get the present value of the operating assets, add cash, subtract out debt, you get a value for the equity. And people are incredibly sloppy about cash, especially when they're doing equity valuations. And here's why. In equity valuation, you start with net income, which should include interest income from cash. And if you don't clean up for it, and you get a value for equity and you add cash, you've actually double counted cash. Once through the income you counted into your cash flow. So, but we know if we're doing things carefully that you separate the cash out, you look at the value of the assets outside of cash, and you add the entire cash balance. But to see why you might not treat cash equally at every company, I'm going to give you a very simple set of choices. Let's assume you're an investor and I come to you with 3 companies. I've been very creative and I've called them Company A, Company B, and Company C. They all have exactly the same enterprise value and cash balances. So there's no question about the cash balance being there. But here's where they're different. Company A has a history of earning a return on capital of 10% on its projects, and its cost of capital is 10%. It's a developed market company. Company B has a history of earning a return on capital of 5%, its cost of capital is 10%, and it's also a developed market company. And Company C is an emerging market company. Let's make it an Argentine company with a return on capital of 22% and a cost of capital of 12%. And they all have a $100 million cash balance. I'm going to argue that in one of these 3 companies, cash is going to be a neutral asset. You know what I mean by a neutral asset? $100 million in cash is valued at $100 million, which is the conventional practice. So in one of those 3 companies, I'm going to be in safe ground. In one of these 3 companies, I'm going to argue there's going to be a discount on the cash. And I'm going to unfairly ask you why, if you tell me, if you agree with me. And one of these 3 companies, you might attach a premium to the cash. Let's start simple. In which of these 3 companies is cash most likely to be a neutral asset? And what is it about Company A that makes it a neutral asset? It is what I call a blah company. What do blah companies do? They basically run in place. They don't help you, they don't hurt you. And don't complain too much about investing in blah companies because there are fates far worse than investing in a blah company. So in which of these 3 companies are going to discount the cash? And what is it about B that troubles you? Their history, right? What do they have a history of? Stupidity. You're attaching a stupidity discount to the cash. You're saying, these guys are so stupid, they will find a way to ruin this for me. And I'm going to preemptively estimate how stupid they are and how much they will ruin and knock off 20%. You think, that sounds so much of a reach. Is it? Would you want Hewlett-Packard to hold $1 of your cash? I wouldn't. This is a company. Every time they have cash, they find a way to screw it up. I'd like to go clear out their checking account at the end of every day and say, no cash for you. I'm going to discount the cash, not because cash is a bad asset or earns a low rate of return, but it's not the cash I'm worried about, it's what they will do with the cash. And in Company C, I might attach a premium. And let me explain why. In traditional corporate finance, no company needs a cash balance. You know why? Because if you have a great project, what do I assume you can do? You go raise capital in markets with no transactions cost. You take the project. What's the big deal? What's the big deal? Well, it's not that easy to go raise capital. It's not costless. But for companies that are big, you're pretty close to that. But let's say you see why I put the company in Argentina now? Argentina is not just an emerging market, but an emerging market that in the last 18 years has had the market freeze. The entire market freezes about 4 to 5 times. Freezes in what sense? You definitely can't raise equity. Banks stop lending money. There is no way you can raise capital. Now do you see why having cash as an Argentine company could give you a strategic weapon? Because the next crisis, what are you going to do? Not only can you survive, you now can use that cash to buy assets at pennies on the dollar from other companies. I know it sounds outlandish, but markets do attach discounts on cash in some companies and premiums on cash in others. In fact, there was a very interesting study that was done. And so as you look across companies, be very clear about why this is happening. Some analysts argue that this is because cash earns a low rate of return. It has nothing to do with the low rate of return. It earns a fair rate of return. It's got everything to do with how worried you are that this company might misuse your cash. So here's what this study did. It actually looked at how much the market was pricing $1 in cash. It's a very clever study because they looked across the US market. They looked at how much the market was attaching as a value to each dollar in cash. They ran this regression with so if you want to read the study, you can see how cleverly it's constructed. So I'll start with the good news. Across all US companies, $1 in cash is valued at $1. You see why that's good news? Because that's what we do all the time. But here's the bad news. If you look at mature companies with negative excess returns, what does that mean, negative excess returns? They're like company B, earning a return on capital lower than the cost of capital. $1 in cash is valued at 69 cents. That is an astonishing discount. What am I saying? The mature company, negative excess returns, $10 billion in cash. I act like you have only $6.9 billion. Why? Because I'm worried about what you'll do with the cash. If you guys are familiar with activist investors, the Carl Icahns, the Bill Ackmans of the world, say Carl Icahn, not the deepest thinker in the world, but he's extraordinarily good at targeting companies. You see why this kind of company is Carl Icahns' sweet spot? Because what does this company have to do to release a $3.1 billion in discount? It's very simple. What do they have to do? Give the cash back. You don't have to pick projects that are better. You don't have to restructure it. Just give the damn cash back. You know how difficult it is to get managers to let loose of that cash? Because we've changed. We're different. We're not going to do this anymore. And Carl Icahn says, I've heard that before. Just give me the cash back. And there are companies, high growth companies, where $1 in cash. So when you see a small, when you look across the ride sharing companies, one of the things I was looking at is how much cash they have. You know why I'm worried about ride sharing companies? In fact, one of my worries with Lyft is that they're only $500 million in cash, as opposed to what? Didi is almost $12 billion in cash. Didi is a horrifically badly run company, don't get me wrong. They can burn through cash at the speed that nobody can match, right? I think they must give, I don't know, if you're from China, they probably would pay you to take their service. I don't know how the app works. You hit the app and say, I want to go from point A, they send you $10 or something. That's how much cash they burn. But they have $12 billion in cash that they raised last year. Grab Taxi has $3 billion in cash. Uber has about $5 billion. And Lyft has only $500 million. You know why I want the company with more cash in this business? They're right now losing money. They're burning through cash. And if you burn through cash and you run through your cash balance, you need to raise cash. And if you can't raise the cash, what happens? You've got to sell yourself to the best potential buyer. That's what you're looking for in young companies. So don't pick on a young company for accumulating cash. It might be what separates them from failure. So that's the first stop. Let's take a detour here. Okay? Do you know what a closed-end mutual fund is? You know how mutual funds work, right? You send your money to the mutual fund. They screw up your money for multiple years. They charge you a fee. And they say, oh, it's all going to be okay. But typical mutual funds, when you send money in it, the size of the fund expands. You basically get a share of whatever the market value of the holdings is. In a closed-end mutual fund, here's what's different. It's a publicly traded stock. So it has a balance sheet, financial statements, 10K, and a market price. But all of its assets are what? Stocks in other companies, which are publicly traded. This should be the easiest of all companies to value, right? All you have to do is take all the stocks they own, take the market prices, add them all up, come up with a number. And you'd expect these funds to trade at roughly whatever the market value. Do you know that closed-end funds through their entire history have traded at a discount of about 15 to 20% on the value of their holdings? It is called, the original paper that wrote this is called the closed-end fund puzzle. Why is it a puzzle? Lots of companies trade at less than the value of the assets, but why in this case is it so puzzling? What's the question you're asking? In other words, it's nothing to do with perfect. You could buy this entire company and then do what? Sell the shares and you should be able to claim the 15% discount. So in a perfect world, that's what should happen. Closed-end funds should cease to exist. But they have constructed them in such a way that taking them over is difficult, and selling off the stock, you actually face an unexpected cost or an expected cost. Right after you liquidate the shares, what do you have to do? You got to pay capital gains taxes. So if they have holding, so it's not that easy. But clearly the question is, why do they trade at this discount? I think I've given you a clue when I described how cash trades at a discount. Why does cash trade at a discount? Because you're worried of what managers will do with the cash, right? The typical mutual fund underperforms the market by roughly 1.5%. So let's play a little game. If you think, I will talk about Berkshire, let's assume that you have a closed-end fund invested in average risk stocks. And let's assume that average risk stocks are expected to make 11.5% a year. And I'm sorry, the market to make 11.5% a year, but this fund you expect to underperform by 0.5% a year. So you walk in with open eyes. You're buying shares in the fund. You expect them to keep doing what they're doing right now, which is to deliver 0.5% less than what they need to. You see what's going to happen? If you invest $100 in this fund, you're going to make about $11 a year, right? So think about it in the long term. So let's keep things simple. Let's assume $100, you make $11. $11 would be the 11.5% minus 0.5%. So you make $11 a year. To value the $11 every year, what discount rate are you going to use? You're going to use the 11.5% because that's what you need to make on investments of equivalent risk. You don't even need to do the math, but if you take $11 as a perpetuity and you make 11.5% discount rate, the present value that you're going to get is about $96.50. See, so what? You invested $100 in stock, you're willing to pay only 90, there's a 3.5% discount. Do you see what that's going to mean? If you have a bunch of closed-end funds, if you want to do a research study, here's an interesting one. Take a bunch of closed-end funds. What's your hypothesis going to be? Some of these closed-end funds are much better at beating the market, some are pretty close to the market, some are much worse. What should you expect to see in terms of discounts? Which of these funds will have the biggest discount? The ones that have the most underperformance will have the biggest discount. The ones that deliver roughly what they need to will have no discount. And if you have a closed-end fund that consistently delivers more than the market, what should you expect to see? A premium over the market value. You think, what chance do I have of finding that fund? There's one very famous closed-end fund. It's not called a closed-end fund, so you don't even think about it as a closed-end fund, which has had a 40-year history of doing this. You know what I'm talking about? It's called Berkshire Hathaway. What does Berkshire Hathaway do? They run an insurance company, they collect premiums, and they give it to a mutual fund manager called Warren Buffett. And for 40 years, he's picked stocks for you. And this is a legendary history, right? And if you look at Berkshire Hathaway, here's what you see. The market value of Berkshire Hathaway should be roughly equal to book value because the book value is all stocks like Coca-Cola, Washington Post, but it's traded as high as 2 times book value, which means that if you buy Berkshire Hathaway, you're paying twice the price of Coca-Cola, what you'd get for Coca-Cola, but you're doing it through Berkshire Hathaway. And the answer is, but you're getting Warren Buffett. But that premium seems to have decreased over time. Why? What is it? Well, it could be mismanagement, but that happened only recently, right? That was after this graph. So part of it is track record. Cash balance is increasing, but that's another way of saying he can't find. There's a much simpler reason. Even if his performance had not changed, the discount would have gotten smaller. He's getting old, exactly. I know it's a morbid thought, but there will be a day when you open up the Wall Street Journal, there'll be a headline that says, Buffett passes away. You can't pay a premium of 2 times book value. Remember, the premium you're paying is for his stock picking skills as long as he's alive. Maybe you have in your vision that he'll come back as a ghost and pick stocks for you, but it's not going to happen. In fact, Warren Buffett hasn't been picking stocks at Berkshire Hathaway now for about 4 or 5 years. He's turned over a big chunk of the stock picking to Combs and Wexler. And they're nice guys, but they're average. I mean, let's face it, they can run in place, they can tell me all the pictures, they can send me pictures, they can show me tables. But even Warren Buffett, if he were starting today, would not be able to do what he did 40 years ago. So I know you don't think of Berkshire Hathaway as a closed-end fund, but actually that cash discount allows you to see this. So I'm going to stop there. When we come back on Monday, I'm going to keep going with the loose ends, but think about the cash balance in your company, whether you attach a discount or a premium.
Can I speak to you for a quick
Yeah,
minute?
yeah.
I messed up. At 3 minutes left, I took the guy's rate next to me on the last question. I thought I'd come to you before you have to come to me about it. I can give you my name.
Okay, so come and talk to me.
Yeah, absolutely. Tomorrow at office hours? Mm-hmm. Perfect. Thank you.
Yep.
So driving crazy. On the second question, there was something that said trading at estimated value. Does that mean that you have to subtract that to get to the? So it's the same as fair value. Thank you.
I know you talked about with GE how the conglomerate business, the model doesn't really work. But what do you think about like the luxury conglomerates? Or it's like kind of like specializing in that luxury space of being
Can't be a
diversified.
luxury conglomerate. Maybe even a luxury
Like
space.
Louis Vuitton, Moet Hennessy, whatever.
I mean, I don't think any of them are conglomerates. They might have gone retailing and apparel. It's more integration across.
But they've been like acquiring like hospitality groups or stuff like that.
I mean, you could argue that maybe they have a skill set that is directed at it. But only it depends on what price they get.
Yeah.
There are ways to make this work, but to make it work, you got to make sure you don't overpay up front. So if they can get it at a reasonable price and they can make changes that make them more valuable, it's a value control issue. The essence of a conglomerate is you don't ever even think about changing the way. You just buy a company because it's in a different business.
Right.
These guys have so they're hoping to bring something in. Whether they do or not is a different question, but that's what they're hoping to do.
Thank you.
My question was just relating to the Warren Buffett, what you're saying. So, are you saying that none of his trades are levered, or like is he investing in?
Why does it matter if it's levered or unlevered? If you have a neutral investment, you lever it, it stays a neutral investment.
Right.
If you have a bad investment, you lever it, it becomes a worse investment.
Yes.
If you have a good investment, so the leverage issue is not an issue.
But is it the same as buying a stock in Coca-Cola when you're buying share?
No, because you're not getting the leverage for benefit. You're actually getting the actual share of Coca-Cola. You're not getting any leverage benefit by buying it through Berkshire Hathaway.
Oh,
There's absolutely no leverage
is
benefit.
it a holding company?
It's part of the company, but the leverage is a non-issue because if I bring the leverage in, you actually have to double the cost of equity for Coca-Cola. So you can't do that. If you think about Coca-Cola standing alone, and you pay a price for that too, you are effectively paying twice the price of Coca-Cola. There's no way around it. There's no leverage effect that you can explain it away.
So when you buy a share in Berkshire Hathaway,
You're essentially paying a premium for the shares on the balance sheet.
okay.
But that premium is not for the shares, it's for the expectation that Warren Buffett will pick more companies like Coca-Cola and deliver more than your required return. That's the only way you can justify the premium. That's why I said as he gets older, you got to worry about the premium more, right? Because
No,
in
I understand that.
1989, if you paid the premium, you were not paying double the price. It looked like you were paying double the price. You were actually paying Coca-Cola's price, but the extra amount you were paying was he's going to keep picking stocks like this one. And when he picks stocks, he makes twice what the rest of the world is making. That's what X $1 million doing. That's what you're capitalizing and putting into the price. So the less you have trust in him, or the older he gets, the less you're willing to pay a premium. So the price to book will start converging on one as you become a more conventional company.
So my question is also, let's just say that Berkshire Hathaway only invested in Coca-Cola, right, over the time, and you invest in Coca-Cola as well. You wouldn't be paying that premium. So you're paying.
So basically, the easier way to get the Buffett effect is pick whatever stock take whichever stock. Oh, thank you. Take whatever stock he has and just go buy it yourself.
And so you don't get any the earnings that are distributed from Berkshire Hathaway that doesn't come to the Is it
Yeah,
like
but it's coming from, so the earnings are coming from the insurance company, right? The earnings come from dividends it receives from Coca-Cola. So if you want to get the dividends from Coca-Cola, why would you want Berkshire Hathaway to be the conduit for those dividends to come to you? There's nothing you gain by doing it, right? So either you love Geico as an insurance company so much that you're willing to pay the